Today, I am going to introduce 10 midcap stocks to invest for the long term. I have identified stocks from 10 sectors to diversify your portfolio. The stock market is on fire, and it's back in a bull run. But wait, there is more. India just hit a whopping $4 trillion in GDP. Can you believe it? Our economy is soaring high, and it's time for us to ride that wave. Now, here is the big question on everyone's mind: when is the Nifty going to double up? I have got some thoughts on that. I have identified 10 midcap stocks you can consider for investment. If you are new to my channel, please do subscribe. Also check out my playlist, Best Stocks to Buy for the Long Term. So let's get started. The 10th stock from our list is from the IT sector. First up, let's talk about the recent surge in Indian IT stocks. You might be wondering why they are gaining momentum. It's because of the optimism that the US Federal Reserve will pause its rate hikes. With inflation easing and the labor market cooling down, there is an expectation that the Fed is putting a hold on its tightening cycle. And you know what? This is great news for Indian IT stocks. With strong recent earnings and positive forecasts, the IT sector seems to be offering a promising investment opportunity. So, if you're considering diversifying your portfolio, the IT sector might just be the game changer you have been looking for. This IT stock specializes in software engineering and strategy services, aiding companies in implementing and modernizing their businesses. I am talking about Persistent Systems Limited. This company stands out with flexible solutions and platforms, including partnerships with industry giants like Salesforce and AWS. Persistent Systems has a strong brand presence, ranking 9th among Indian IT services companies and exhibiting significant growth in brand value. Operating in 21+ countries, the company's revenue is diversified across regions, with a significant contribution from North Central America. The revenue breakup includes a dominant 70% from technology services, 26% from partnership operations, and 4% from Accelerite products. With 350+ clients, including top global corporations, Persistent Systems has a robust order book, with a total contract value of $1.2226 billion in 2022. The company has strategically acquired over 14 entities in the past decade, strengthening its digital capabilities. Notable acquisitions include Software Corporation International, Shree Partners, Shoreline Systems, Data Glove, and Media Agility. Let's do a basic financial overview. The stock is currently priced at 6,380 rupees with a market cap of 49,130.84 crore. The company operates with a PE ratio of 49.98 and a PB ratio of 10.86, indicating its valuation in the market. With a face value of 10 rupees, the company boasts a healthy dividend yield of 0.78% and a book value of 588 rupees. In terms of earnings, Persistent Systems has an EPS of 127 rupees, showcasing robust profitability. The sales growth over the past year stands at an impressive 43.13%, and the company has maintained a strong return on equity, ROE, at 22.85%. Analyst ratings and shareholding. Persistent Systems is under the scrutiny of 31 analysts, with 35% rating it as a buy and 16% as outperform. However, 13% of analysts recommend selling. The company has a healthy promoter holding of 31%, while public holding stands at 66%. Mutual fund and FII holdings have also increased. Let's discuss the strengths and weaknesses of the company. Strengths: consistent high returns over 5 years, improving cash flow, and a new 52-week high. Efficient capital and shareholder fund utilization, low debt, and increasing revenue and profits. Company with zero promoter pledge. Weaknesses: trading at 11.1 times its book value. Persistent Systems appears to be a robust player in the IT services sector with a global footprint, strong financials, and strategic partnerships. Despite a relatively high valuation, the company's consistent growth, client base, and innovative approach position it as a potential investment opportunity for the long term. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decision. The 9th stock from our list is from the auto ancillary sector. This stock provides auto parts for Vande Bharat Express. They have recently bagged an order worth about rupees 12,227 crore from the Railways Ministry to supply 15.40 lakh forged wheels under the government's Atmanirbhar Bharat initiative. The contract spans over 20 years, with the delivery of 40,000 forged wheels in the first year, 60,000 in the second year, and 80,000 wheels annually thereafter. I am talking about Ramkrishna Forgings. They specialize in manufacturing and sale of forged components of automobiles, railway wagons, coaches, and engineering parts. Established as the second largest forging player in India, they have a strong client base including Tata Motors, Indian Railways, Bharat Benz, Volvo, and more. The company's revenue breakup showcases a diverse portfolio, with approximately 79% derived from the automotive sector, 21% from non-auto segments. Ramkrishna Forgings has secured its position through strategic acquisitions, including Zuyo Manufacturing, Rites Limited, JMT Auto, and Multitech Auto Private Limited. These acquisitions have not only expanded the company's product offerings but also contributed to its ranking among key players in the forging industry. Let's do a basic financial overview. The stock is currently priced at Rs 725 with a market capitalization of Rs 13,103.12 crore. The company operates with a PE ratio of 46.65 and a PB ratio of 5.15, indicating its market valuation. Having a face value of Rs 2, the company offers a dividend yield of 0.28% and the book value stands at Rs 140.64. The company has demonstrated robust sales growth of 31.31% and profit growth of 14.09% increase over the past year. Additionally, Ramkrishna Forgings maintains a solid return on equity of 19.79%. Analyst ratings and shareholding. The company is under the scrutiny of 8 analysts, with 75% rating it as a buy and 13% as hold. However, 13% of analysts recommend selling. The company has a healthy promoter holding of 47.41%, while public holding stands at 52.49%. Mutual fund and FII holdings have also increased. Let's discuss the strengths and weaknesses of the company. Strengths. The company has shown a good profit growth of 190.46% for the past 3 years. Good cash flow management and high trailing 12 months EPS growth. Weaknesses. The stock is trading at 7.72 times its book value, and there are concerns about capitalizing interest costs. Mutual funds decreased their shareholding last quarter, and there is a relatively high level of promoter stock pledges. Ramkrishna Forgings stands as a prominent player in the forging industry. While there are strengths to consider, such as strong financial performance and industry position, investors should also be mindful of potential weaknesses like stock valuation and high promoter stock pledges. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The 8th stock from our list is from the metals mining sector. The global metal scrap recycling market is worth over $500 billion wherein India's share is only 2.2% of the industry. Recycling is poised to emerge as a dominant theme in the metals industry. Ferrous metal recycling in India has the potential to reduce emissions by 59%. Metal recycling benefits various sectors and businesses. This stock is a recycling company specializing in metals and paper. I am talking about Gravita India. Founded in 1992 in Jaipur, Gravita India specializes in lead, aluminium, plastics, and rubber recycling, serving both domestic and global markets. With a widespread international presence, the company's robust clientele spans over 375 customers across Asia, the Middle East, Europe, and the Americas, encompassing 38 countries. Simultaneously, their operations within India cater to more than 230 customers in 22 states. The company's revenue breakup showcases a diverse portfolio, with approximately 88.71% generated from the lead segment, 6.57% from aluminium, 3.30% from plastic products, 1.35% from other projects. The company has 22 subsidiaries in 2023. Let's do a basic financial overview. The stock is currently priced at Rs 1,113 with a market capitalization of Rs 7,685 crores. The company operates with a PE ratio of 34.3 and a PB ratio of 21.32, indicating its market valuation. Having a face value of Rs 2, the company offers a dividend yield of 0.28% and the book value stands at Rs 52.21. The company has demonstrated robust sales growth of 33.27% and profit growth of 154.47% increase over the past year. Additionally, Gravita India maintains a solid return on equity of 39.17%. Analyst ratings and shareholding. The company is under the scrutiny of 3 analysts, with 100% rating it as a buy. The company has a promoter holding of 66.48%, while public holding stands at 52.49%. The ABI holdings have also increased. Let's discuss the strengths and weaknesses of the company. Strengths. Company with zero promoter pledge. High trailing 12 months EPS growth. Good quarterly growth in the recent results. Near 52-week high. Weaknesses. Declining net cash flow. Gravita India stands as a prominent player in the recycling industry. While there are strengths to consider, such as strong financial performance and industry position, investors should also be mindful of potential weaknesses like stock valuation. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The 7th stock from our list is from the defense sector. The Indian government's Make in India push in the defense sector has meant that there is a move to source equipment locally. This is good news for public and private companies in this sector. The country's indigenous purchases, which were at 54% in 2019, are expected to go to 75% in 2024 and beyond. In the financial year 2023, the Indian government approved acquisition of around 2.7 lakh crore worth defense equipment with 99% domestic sourcing. India's capital expenditure towards defense has grown at a compounded annual growth rate of 9% from 2010. This stock is a leading player in the construction of all kinds of vessels, repairs and refits of all types of vessels, including periodic upgradation and life extension of ships. I am talking about Cochin Shipyard Limited. Incorporated in the year 1972, this company has built repaired some of the largest ships for its esteemed customers across the globe. It has exported some 45 ships to various clients outside India. Cochin Shipyard Limited is India's first greenfield shipbuilding yard and the only yard which can repair air defense ships. The company has ship repair facilities at Kolkata, Andaman Nicobar, Mumbai. It has an international ship repair facility at Kochi and has recently acquired Tebma Shipyard at Malpe. Their clientele in domestic markets includes Indian Navy, Indian Coast Guard, Shipping Corporation of India Limited. Its international clients list consists of National Petroleum Construction Company, Abu Dhabi, the Clipper Group, Bahamas, Vroon Offshore, Netherlands, and Sigba as Norway. The company's revenue breakup showcases a diverse portfolio, with approximately 69.5% generated from indigenous aircraft carriers, 13.5% from other vessels, 16.6% from ship repairs, 0.4% from the sale of scrap shipbuilding financial assistance. Cochin Shipyard has secured its position in deep-sea fishing vessels through the strategic acquisition of Tebma Shipyards Limited. Let's do a basic financial overview. The stock is currently priced at 1,093 rupees with a market capitalization of 14,376 crores. The company operates with a PE ratio of 34.4 and a PB ratio of 3.05, indicating its market valuation. Having a face value of 10 rupees, the company offers a dividend yield of 1.55%, and the book value stands at 358 rupees 44 paise. Additionally, Cochin Shipyard maintains a solid return on equity, ROE, of 7.62%. Analyst ratings and shareholding. The company is under the scrutiny of 4 analysts, with 25% rating it as a buy, 50% rating at hold. The company has a promoter holding of 72.86%, while public holding stands at 27.14%. The mutual fund holding has decreased from the last quarter. Let's discuss the strengths and weaknesses of the company. Strengths. Company with zero promoter pledge. Low debt. Overbought by money flow index. Good quarterly growth in the recent results, improving cash flow. Weaknesses. Degrowth in revenue and profit. Annual net profit declining for the last 2 years. Mutual funds decreased their shareholding last quarter. Cochin Shipyard stands as a prominent player in the shipbuilding industry. While there are strengths to consider, investors should also be mindful of potential weaknesses like stock valuation and degrowth in revenue and profit. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The 6th stock from our list is from the jewelry and luxury sector. Today, the gems and jewelry industry has become one of the largest businesses in India, playing an important role in the Indian economy. If we go through the statistical data, it contributes 7% of the country's GDP and 15.71% of India's total merchandise exports, which itself is one of the fastest growing sectors. As a result, The industry brings in a huge amount of foreign exchange and provides employment to over 4.64 million workers in both organized and unorganized sectors. Being the most growing sector, the Government of India has also taken measures to promote the growth of the gems and jewelry industry. This stock is one of the largest jewelry retailers in India. I am talking about Kalyan Jewellers India. The company is a major player in the Indian jewelry industry, boosting a diverse product range catering to various customer segments. Kalyan Jewellers has a robust portfolio of brands, each catering to specific product segments. Notably, their revenue distribution in FY20 showcases a dominance in the sale of gold products at 76%, followed by studded products at 22%, and other products at 2%. With a growing international presence, Kalyan Jewellers operates in 5 Middle East countries, contributing 18% to its financial year 2023 revenues. They have 4 in-house manufacturing facilities in Sharjah and Oman. With 149 showrooms in India and 33 in the Middle East, the company has a solid distribution network concentrated in states like Maharashtra, UP, Tamil Nadu, Kerala, and Karnataka, with plans to expand further in non-South markets. Let's do a basic financial overview. The stock is currently priced at Rs 332 with a market capitalization of Rs 34,162 crores. The company operates with a price earnings (PE) ratio of 65.9 and a price book (PB) ratio of 9.05, indicating its market valuation. Having a face value of Rs 10, the company offers a dividend yield of 0.15%. And the book value stands at Rs 37.39. Additionally, Kalyan Jewellers maintains a solid return on equity, ROE, of 11.25%. Analyst ratings and shareholding. The company is under the scrutiny of 6 analysts, with 67% rating it as a buy, 33% rating it as outperform. The company has a promoter holding of 60.55%, while public holding stands at 39.45%. The foreign institutional investor, FII, and mutual fund holding have decreased from the last quarter. Let's discuss the strengths and weaknesses of the company. Strengths: high trailing 12 months, DTM, earnings per share, EPS, growth. Zero promoter pledge. Good quarterly growth in the recent results. Weaknesses: decline in net profit with falling profit margin. Mutual funds decreased their shareholding last quarter. Kalyan Jewellers India appears to be strategically positioning itself for both domestic and international growth. While there are strengths to consider, investors should also be mindful of potential weaknesses like stock valuation and poor ROE. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The fifth stock from our list is from the finance sector. This stock is a non-banking financial company registered with the Reserve Bank of India under the category of investment company. I am talking about Tata Investment Corporation. Its primary focus is on investing in a wide range of industries, both in listed and unlisted equity shares, debt instruments, and mutual funds. The company boasts a diversified investment portfolio, with holdings in 85 companies as of March 31, 2023. Notably, 62 of these companies are quoted, while 23 are unquoted, showcasing a balanced approach to risk. Tata Investment Corporation's investments span Tata and non-Tata companies, with a significant emphasis on the former. As of the financial year 23, the breakdown of the company's investments reveals 80% in quoted equity shares with a net value of 2,577 crores. 20% in unquoted equity shares with a net value of 650 crores. The company has a subsidiary, Simto Investment Company Ltd, which is an NBFC registered with the Reserve Bank of India. Simto Investment actively manages its portfolio to capitalize on short-term market volatility. Tata Investment Corporation also holds stakes in key associate companies like Tata Asset Management Ltd, Tata Trustee Co. Ltd, and Amalgamated Plantations Pvt Limited. Looking at the company's revenue breakdown, dividends contribute 63% to revenue, interest income accounts for 14%, and fair value change gains make up the remaining 23%. Let's do a basic financial overview. The stock is currently priced at 4,227 Indian rupees with a market capitalization of 21,385 crores. The company operates with a price-earnings ratio of 65.9 and a price-book ratio of 0.91, indicating its market valuation. Having a face value of 10 Indian rupees, the company offers a dividend yield of 1.23% and the book value stands at 4,647.52 rupees. Return on equity, ROE, stands at 1.33%. Shareholding information. The company has a promoter holding of 73.38%, while public holding stands at 26.62%. The foreign institutional investor and mutual fund holding has decreased from the last quarter. Let's discuss the strengths and weaknesses of the company. Strengths: zero promoter pledge. Low debt. Stock gained more than 20% in 1 month. Overbought by money flow index. Weaknesses: declining net cash flow. Decline in net profit. Tata Investment Corporation emerges as a hidden gem in the investment landscape. While there are strengths to consider, investors should also be mindful of potential weaknesses like poor return on equity and return on capital employed. Its consistent performance, coupled with its association with reputable companies, positions it as an intriguing option for investors seeking long-term stability and growth. The fourth stock from our list is from the EMS sector. India's EMS sector is evolving rapidly and holds great promise. This industry has been quietly reshaping the Indian economy. It's essential to recognize the global significance of EMS. This sector plays a pivotal role in producing the electronic components for some of the world's most renowned brands. The Indian EMS market is a hidden gem with the potential for multi-bagger returns in the next 5 to 10 years. Today, electronics are the backbone of numerous global digital revolutions, from AI and IoT to electric vehicles, 5G, and more. Several factors have positioned the Indian EMS market as the world's fastest growing. This stock is a leading end-to-end and IoT solutions-enabled EMS company. I am talking about Kaynes Technology India. Incorporated in 2008, Kaynes Technology has catered to a wide range of industries, including automotive, industrial, aerospace, and more. The company operates 8 manufacturing facilities across India, strategically located in states like Karnataka, Haryana, and Tamil Nadu. As of June 2022, Kaynes Technology's order book stands at a whopping 2,200 crore, which is 3.1 times their fiscal year 2022 revenue. This indicates a robust pipeline and strong customer demand. Kaynes Technology serves 229 customers in 21 countries, with around 20% of their revenue coming from exports. The company's revenue breakup showcases a diverse portfolio, with approximately 33.56% generated from the automotive industry, 29.8% from the industrial sector, 10.08% from medical services, 10.35% from railways, 8.37% from consumer products, 2.52% from aerospace defense, and 5.32% from IoT IT. Let's do a basic financial overview. The stock is currently priced at Rs 2,430 with a market capitalization of Rs 14,376 crore. The company operates with a PE ratio of 128.31 and a PB ratio of 13.98, indicating its market valuation. Having a face value of 10 rupees, the company currently does not offer a dividend yield. The book value stands at Rs 173.53. Additionally, Kaynes Technology maintains a return on equity of 16.34%. Let's discuss the strengths and weaknesses of the company. Strengths: low debt, zero promoter pledge, strong annual EPS growth. Weaknesses: declining cash flow from operations for the last 2 years, trading at 14 times its book value. Kaynes Technology stands at the forefront of innovation in the electronics manufacturing industry. While there are strengths to consider, investors should also be mindful of potential weaknesses like stock valuation. The third stock from our list is from the textile sector. This stock is a leading manufacturer of the finest fabrics in the world. I am talking about Gokaldas Exports. This company deals in a broad range of apparel products that include outerwear, activewear, and fashion wear for all weather and seasons. The company's product sales mix in fiscal year 2023 reveals a diverse portfolio. About 46% of revenue is derived from fashion wear, 36% from outerwear, 9% from bottom wear, and another 9% from sportswear. The company exports to 50+ countries. The company has incorporated 3 wholly owned subsidiaries. Let's do a basic financial overview. The stock is currently priced at 935 Indian rupees with a market capitalization of 5,670 crores. The company operates with a PE ratio of 39 and a PB ratio of 5.79, indicating its market valuation. Having a face value of 5 Indian rupees, The company offers a dividend yield of 0.11%. The book value stands at 161.61 Indian rupees. Additionally, Gokaldas Exports maintains a return on equity of 22.78%. Let's discuss the strengths and weaknesses of the company. Strengths: low debt, zero promoter pledge. Weaknesses: declining net cash flow, degrowth in revenue and profit. While there are strengths to consider, investors should also be mindful of potential weaknesses like stock valuation and degrowth in revenue and profit. The second stock from our list is from the healthcare sector. The Indian healthcare industry has been growing at a compound annual growth rate, CAGR, of about 14 to 15% since 2016. To promote medical tourism in the country, the Government of India is extending the electronic medical visa facility to the citizens of 156 countries. India's surgical robotics market is estimated to expand to hit the size of $350 million by 2025. This stock is one of the largest corporate healthcare groups in India. I am talking about Krishna Institute of Medical Sciences. The company operates 9 multi-specialty hospitals under the Kaynes Hospitals brand. Kaynes stands as a regional healthcare powerhouse, boosting leadership in both Andhra Pradesh and Telangana. Offering over 25 specialties and super specialties, including cardiac sciences, oncology, neurosciences, and more, Kaynes ensures a comprehensive range of healthcare services for its patients. Let's talk numbers. Cardiac care takes the lead, contributing 17% to the revenue mix, followed by neurosciences at 11% and renal sciences at 9%. With 67% of the financial year 22 revenue coming from the Telangana cluster, Kaynes has strategically positioned itself for success. Let's do a basic financial overview. The stock is currently priced at 1,930 Indian rupees with a market capitalization of 15,450.96 crores. The company operates with a price-earnings (PE) ratio of 45 and a price-book (PB) ratio of 8, indicating its market valuation. Having a face value of 10 Indian rupees, the company doesn't offer any dividends. The book value stands at 219.93 Indian rupees. Additionally, Kaynes maintains a return on equity of 16.79%. Let's discuss the strengths and weaknesses of the company. Strengths: low debt, increasing revenue every quarter, annual net profits improving. Weaknesses: high promoter stock pledges, declining net cash flow. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. The first stock from our list is from the railway sector. The Indian railway sector presents long-term growth opportunities for investors, given the substantial government support, increasing demand for both passenger and freight services. India has one of the world's largest rail networks in terms of passenger traffic. The Indian government has set an ambitious target to produce 400 Vande Bharat trains in India by the end of 2024-25. This railway stock is an Indian engineering and consulting firm offering transportation infrastructure services worldwide. I am talking about Rites Limited. Established in 1974, Rites Limited is a key player in the transport consultancy and engineering sector in India. The company engages in a variety of services, ranging from consultancy and engineering to project management. These services span across railways, highways, airports, ports, ropeways, urban transport, and inland waterways, both in India and abroad. The company has successfully undertaken projects in over 55 countries across Asia, Africa, Latin America, South America, and the Middle East. Domestically, India holds a major share, accounting for 90% in the financial year 2021. In terms of exports, Africa contributes 7% and Asia 3% in the financial year 2021. The company has a subsidiary, REMC Ltd, mandated for power procurement under Open Access for Indian Railways. Let's do a basic financial overview. The stock is currently priced at 472 Indian rupees with a market capitalization of 11,345 crores. The company operates with a price-earnings ratio of 23 and a price-book ratio of 4, indicating its market valuation. Having a face value of 10 Indian rupees, the company offers a dividend yield of 4.35%. The book value stands at 103.37 Indian rupees. Additionally, Rites maintains a return on equity of 21.64%. Let's discuss the strengths and weaknesses of the company. Strengths: overbought by money flow index, no debt, zero promoter pledge. Weaknesses: degrowth in revenue and profit, decline in net profit. As always, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. Remember, always conduct thorough research before making investment decisions. I hope you found this video informative and subscribe to our channel for more informative videos.